Welcome back to the Undervalued Investor YouTube channel, where today we're taking a look at the Toronto Stock Exchange that is an absolute free fall. We'll talk about the microscope that's on the political landscape, the higher interest rate environment pressuring a lot of these stocks that are now trading at 52-week lows with some record high dividend yields. And if that is a conversation you'd appreciate, as always, hit that like button, because the Toronto Stock Exchange is hitting its year-to-date low, trading down about 6.7% from over the last 2 weeks alone, which is the biggest drop it has experienced in quite some time. Taking a look at the heat map, outside of a couple energy companies which have been propping up the Canadian economy and the few technology companies we have exposure to, the financial sector being the largest sector in the whole economy has been getting hit exceptionally hard here, along with obviously basic materials, our railways, and a lot of the other major infrastructure-based companies. Now, from the political landscape, there's been a lot of drama with the Nazi that was recently applauded in the House of Commons, leading to the primary speaker, after decades of service, stepping down, to the likes of Elon Musk even accusing Justin Trudeau of crushing free speech with new policies coming out around journalism and the social media sphere. But realistically, a lot of what's going on in the Canadian economy is heading us toward a recession as it looks in the moment, as we had negative GDP for the last quarter, which if we have another quarter of negative GDP, we'll be in an official recession. And that all comes from basically this double-edged sword of record immigration that we are still hitting absolutely absurd numbers of people flowing into the country. And that leads to this really interesting scenario where companies are hitting record customer acquisitions, but they're fighting this headwind of the higher interest rate environment. And that is leading obviously the major sectors like the banks and the shaky interest rate environment to obviously devalue some of their AAA rated loans, leading to higher loan loss provisions that end up hitting their bottom line EPS. But in the same note, I mean, you have all these other companies, especially Royal Bank, bringing in these crazy amount of customers, and they have a fairly robust balance sheet as it currently stands in this market environment. And in fact, a lot of the banks aren't even seeing delinquency ratings in their mortgages any higher than they were during, actually, most of them are 50% lower than where they were during the pandemic. So the question is it just a ticking time bomb before these banks get absolutely hit? Or is this just something that's been priced into these stocks already? Because Royal Bank's yielding 4.65%, TD's at 4.76%, Bank of Nova Scotia's at 7.11%, which is just absolutely astounding. And in the realm of telecom giants, which we only have 3 or 4, you look at something like Bell yielding 7.6% right now. These companies have done a massive amount of layoffs. They're trying to refine and dine their businesses by pulling the levers they have capable to them. So hopefully they don't have to cut these dividends. But you look at something like TELUS, for example, that hit a decade record of customer acquisition. At the same time, we saw their net interest payments, skyrocket pretty dramatically to $316 million, which was up 64% on a year-over-year basis. But as mentioned, crude oil is the primary factor that's propping up a lot of the Canadian economy over the last 2 weeks. When you look at things like Canadian Natural Resources, which actually hit a year-to-date high before pulling back slightly just in the last week alone, but still holding up absolutely incredibly. You're seeing the same with Suncor, holding up pretty nicely. But these companies have direct exposure to oil. So when oil does well, these companies tend to follow that cyclical nature of the oil price. Whereas a lot of the energy companies like Enbridge, which is Canada's fourth largest company, I mean, this has direct exposure to infrastructure similar to the telecom giants. So when obviously interest rates stay high, they're going to be paying exuberant amounts of interest rates. But these companies have a very foundational place in the entire system of our economies. I mean, Enbridge is the largest pipeline company globally, spanning all the way from Alberta down to basically Texas, all the way down in the States, which is absolutely mind-boggling that these infrastructure companies, they can't ever go bankrupt. And if they did, there's going to be government bailouts, because these are huge infrastructure plays to how the entire systems work. So the question you kind of got to ask yourself here is, when you're looking at these infrastructure plays that are directly affected by higher interest rates, is it worth picking them up here, or waiting for the inflection point where we know interest rates aren't going to go any higher and we're likely heading toward an interest rate cut? Because that's when all this expense from these higher interest rates start coming back to their bottom line EPS, and the stocks will likely begin to recover. So there's definitely a large setup at play here. It's just a matter of, how long is this economic turmoil going to last? And is it going to have a dramatic effect breaking the backbone of the economy? Perhaps real estate breaks or something else in the economy breaks that could lead to a wicked collapse in the stock market further, followed by probably an interest rate cut that would then lead to an inevitable recovery. But I'll pass that question off to you. We'd love to know what you think in that comment section below.